Hi, what's up everyone? This is Darren Ng from Fast Track Property. We are at the start of December and I really love December. You can feel the holiday and Christmas spirit in the air and I wake up with a smile every day. Today, I'm going to share with you why I love property investment so much and the reasons why I feel it's one of the safest investment available to all of us, though it is also one of the most pricey. And anyway, for myself, as a rule of thumb, I like to work towards the investments that are the most difficult to reach and then use its profits to reinvest into smaller investments. Take for example, you could use the simplest of strategy, the real estate hack, keeping aside $700 a month, which would then translate into about $8,400 in a year, and then use these monies to reinvest into 140 shares of Citibank. This will give you an infinite ROI. And this is because you're able to collect the dividends and also get to enjoy its capital gains. All of which are not your monies from your own hard work, right? Only decision making. And then repeating this again the following year and the year after. It's like having Citibank's shares for free. And if you guys are not excited about this, knock knock knock, I think you will in the next part. So what are the three buckets of gold for real estate? You have heard of many people saying that they have made money from the sale of their property, while others needed to top up their monthly mortgage on top of their rental. And then there are those that say they are making positive cash flow and have mastered the art of pushing up their ROI and increasing their cash on cash returns. So many financial terms and so many jargons. Well, let me break it down for you to understand. Let us start the video here. So this is the example. If you bought a property for $1 million, you take on a loan of 750k. There'll be a down payment that you make. It comes out to 250k, stamp duties, legal and miscellaneous fees. Your total capital outlay will be 278,100. Alright? And then on this side, you have money that comes out from your pocket, and that will be your installments at 2,589, maintenance at 300, property tax of estimated also 300, and your personal income tax of 120, which comes up to a grand total of monies out of a pocket every month, 3309. Alright, so the first pot of gold is called positive cash flow, which effectively means cash on cash returns, meaning the cash flow you get after deducting all the expenses that you pay and then dividing it by the initial down payment you have made. And if the reverse happens, it means it is a negative cash on cash. This property takes money out of your pocket. So for this example, the total cash outlay is at 278,100 and your monthly outlay will be 3309, and in the event you manage to rent this place for 3,500, your positive cash flow will be you minus this will give you $191. Alright? Therefore, it will mean that your cash on cash in a year will be $2,292 divided by 278,100 can come out with a 0.82%. Alright? And if you use this table to do a calculation for other forms of real estate, the cash on cash could come out to as high as 4.2%. And this is a reason why many are enticed to buy into industrial properties. But let's be real. Is getting a rental of 3,500 even possible? For most of us, it is not possible. Market is only transacting around $3,000, therefore, you will be coming out a difference of 309. Right? And the answer is yes. You are able to still make 3,500, but you need to use the real estate hack too. Okay, I will leave all the other video links that I've done in the description for your reference. The real estate hack tool will increase your rental rates of between $500 to $1,000 a month, but you have to put in the effort to enjoy this pot of gold. Alright, the second pot of gold is what I call the unseen passive income or ghost money. Back to earlier the example, you can see that when you take on a 750k loan, right, at 1.5% for 30 years, the monthly mortgage is around 2,589. Let me show it to you from the calculator. From here, you're able to see the breakdown, right? This is 750k, 1.5% for 30 years. This is 2,588.40, so I round it up to 2,589. I still remember that when I first got interested in property investment, I played with this calculator daily to truly fully understand how the money moves And it is from this table that you will truly appreciate and understand what reducing balance interest really means, and the reason why I kept telling all of you to use CPF instead, because you will enjoy the compounding interest. From here, under the annual, you will see that the total amount of 2588.40 per year, you have paid 31,060.82. It breaks down between the interest and principal, right? So what does this mean? The interest would then mean this is the monies that is income for the bank, and the principal basically is a reduction of your outstanding loan, which effectively means it is your money. All right. If you were to calculate, if you look at this further down, you realize that the interest year after year will actually drop, right? This is meaning this is called reducing balance interest. If you break it down to your monthly, yeah, you also see that this is the difference here. Interest rate, the principal, it also drops. All right. The summary, it tells you that over the course of 30 years, you will have paid in total 181,824.57 for interest, right? So it's really good because this is ghost money. As you put your money, as you rent out your property, someone else is actually putting money into the bank for you, and you are saving this money passively. All right. So back to this. So how much is considered a good return? Many claim is that I'm really happy as long as my money grows at inflation, which is around 2.5%. And today, I'm very sure that if the banks are offering that as a fixed deposit, many will rush over and put in their money, right? But let's get this into perspective. At $100,000, 2.5, that's a simple interest, all right? This is the amount that you enjoy, 37,500 over 15 years. And if you change this to 5%, all right, you'll come up to 75,000. And of course, if you change this to 8%, obviously you have much more interest, and that is putting your money to work harder for you. Now back to this example, for a period of 15 years renting at an average of $3,000, right? And all you ever did was a laziest way of renting at market, and you need to top up $309 a month, and finally only able to sell at the same price. Now, what would the numbers work out to be? At $1 million 15 years later, your outstanding loan would roughly be around $417,000. This will give you a gross return of $583,000. Okay, we have to now less off your initial down payment, right? Your initial down payment will be $278,100, and not forgetting, because you have to top up $309 a month for the next 15 years. This would then be $55,620, right? So your total money out of pocket will be 333,720, which result in a net profits of $249,280. All right. If you take this amount, you divide this by 333,720, will give you 74.6% returns over 15 years, and results to per year, all right, 4.98%. All right. Now, not too bad, right? All right, because you still have a chance of having capital appreciation. And this is the part I love most, and also why I feel that property is the least risky class of investment. Right? I project the worst case scenario of selling at $900,000. Of course, many of you will say, then don't sell, right? But let's just work out the numbers to understand our risk. At 900K, basically this will drop to 149,280. That will translate to a returns of 44.73% over 15 years, which will also equate to 2.98% a year. All right. Basically, this still beats inflation on a worst case scenario. And in fact, if this was performing better and you were using cash to pay for this property, at any point from the 5th year, you could have already had the choice of doing a refinancing, and of which your returns will possibly come up to even 15 to 20% a year. Are you excited now? Alright, I hope you are. Right, moving on to the third part of gold, capital appreciation. This is what we all look forward to. Capital appreciation means the amount you gain above your purchase price, right? If you bought the property at 1 million, you sell 1.1 million, the 100K will be your capital appreciation, alright? And now the best thing is that after cashing this out, adding on with the original capital, you can now move on to buy and own a larger quantum asset. And obviously, guys, the best is for you to get your hands on a property that can give you all three pots of gold. You will not only just control a fantastic quality asset, but it's going to generate you all three pots of gold for a very long time. I hope you enjoyed this video, and if you haven't done so, smash the like button, share this video and bless whomever you think may benefit from it, and remember to subscribe. Till next time, take care.